Morning and welcome to the CIE Investor Call. I'm Marty Switzer, the CEO of Contango Asset Management. With me is Shawn Burns, the Portfolio Manager of Contango Income Generator. It's fantastic to be here with you all this morning. We're very delighted at the large number of shareholders that have attended this call, so we thank you very much for your support. This session is really about you. I'm going to ask Shawn a few questions, but then this is the chance for you to get access to Shawn, to ask him any questions you've got about your investment and how he's running the portfolio. There is a question section, which is in your control panel. If you click on the field that says questions, you can then write in that question and feel free to ask them throughout the interview and we'll go straight to them. So it's wonderful to be there, and without further ado, I might start having a chat to Burnsy. Morning, Shawn.
Hey Marty, how are you?
Mate, very well. Good to be here with you today. So look, Shawn, before we sort of kick off and start talking about the fund itself, can you give our shareholders a bit of background on the market environment? You know, it's been volatile on the back of trade wars, Brexit, inverting yield curves, and a whole lot more. Give us the house view at the moment on the macroeconomic backdrop right now and what you are seeing in the months ahead.
Yeah, sure, Marty. I think that well, certainly it's been interesting. It's like an ongoing soap opera, isn't it? With what's happening at the moment. I think that when we look at it, we see probably the conclusion that we come to is you're going to see continued low growth and low interest rates. Now, what we've seen over the last few months is interest rates rally, spectacularly. With the Australian 10-year bond, government bond dropping below 1%, it's backed up a bit above that now, and world growth sort of positive but slow, and we're not seeing any real cycles that we used to see back in the 80s and 90s. We don't expect those. Our view is we don't expect to see those type of cycles coming back again. We just see a prolonged period of low growth and low interest rates. And when you look around the world at the US long bonds and European, Japanese long bonds, a lot of them are basically around zero. At 30-year bonds, not much different to zero. So implies like long periods of low growth, and where any type of sustainable yield will be valuable.
Shawn, on the back of that, we will get into how the portfolio is performing and how you're positioning it in a low rate world. But before we do that, obviously a key moment for investors is reporting season. A number of our companies, or all our companies, reported last month. Can you run us through how they performed and give us, I guess, a general sort of update on reporting season more broadly?
Yes, yeah, sure. Just going back, the last few result seasons have been pretty tough for the space we're in, and when you look at what's happened over the previous 6 months that the companies would have been talking about, we had the federal election in there, we had growth slowing in Australia quite markedly, interest rate cuts because of that slow growth. So I was actually quite fearful of what we were about to see for our companies going into result season. But at the end of the day, they ended up doing better than certainly better than what was feared. Was it a great result season? No, it wasn't great, but better than expectations, and that's probably the first time for a while that I can say that. So we had a whole string of companies that we were happy with their results. The ones in the portfolio that sort of stood out from our point of view is Lend-Lease, which we got into a few months ago. That continues. That's a big property company, had some issues with some of their contracts. The share price fell from 22 down to around 12. We started buying around mid-12s, and so that progressing its way out. Charter Hall, we've held that since inception, I think, in the fund. That's been a spectacularly successful fund gatherer in the property space. The share price has gone from around $4 or $5 up to $12. Their results are still quite strong. That stock is now at the point where we are taking profits. We're harvesting, its yield has fallen a lot. Still a good story, but it was a top 10 holding. Now we're sort of chopping into it and taking profits. Smart Group was another one which, to go back, we held that stock, we sold it at higher levels. They raised capital, I think, around $11, and the share price fell dramatically when they do salary packaging and car leasing. That market was quite soft with car sales. The share price fell precipitously. We started buying it. I think around $10. We kept buying it. It bottomed in the 7s, and then they had a reasonable result. I wouldn't say a spectacular result, but solid result. Share price took that really well and bounced all the way back up to $11. So it shows you what type of market environment we're operating in. Another couple, Babcock, I think that that's been around top 10 holding for us. We have been quite wary of anything exposed to the more discretionary area of the Australian economy. Babcock's probably in the middle there. It's probably not that discretionary, but has some overtones of discretion in there, discretionary spending. They had a pretty solid result, and we're happy with how they're going. I think when you look at your exposure to those type of companies, you have to try and skew towards management, which knows what they're doing and making the right decisions in tough environment, and also some balance sheet strength as well. And I think also, we have some exposure to the banks. Banks have been under the pump a lot over the last couple of years, especially the major banks and some regionals. And we have we have a small holding in my state. I thought that was actually the pick of the bank results. They did pretty well given a pretty tough environment. They're doing what a small bank should be doing now, and that's grabbing share from the big guys while they're on the back foot. So that sort of gives you a flavour of, but there was a couple of poor results, but overall it was, I was reasonably happy with the way they went out. And also just the general tone for, we've seen a lot of you describe a lot of our stocks as value or yield type stocks. They've been actually hammered in the last few results season. This result season, we saw some of the more flashy type stocks sort of come under a little bit of pressure as well. Which is the
more growth type companies.
That's right. Sort of coming under. The market was probably a little bit more critical of them this time around, which I think helps us. So that's good.
And Burns, you were saying before that you felt that why you're potentially seeing a bit of a shift there is that traditionally a lot of these growth companies had reported averagely, but the market ignored it. You're saying this reporting season they were a lot more onto average news, and I guess some of the pain was shared.
I think that's we're seeing some of these stocks a lot of these stocks have had huge rallies. They're on, some of them are on very high valuations. So
easy growth companies.
It's so now they're at some point you have to keep delivering. The bonds are backed up a bit, so there's a little bit of a doubt around them. Meanwhile, our companies keep doing what they've been doing, chugging along at sort of like mid-single-digit levels of growth.
Bertie, let's talk about the performance of the portfolio. So, one of the key things this fund has consistently done since inception is provide reliable income streams with a good level of franking. For the last financial year, the dividend yield was 5.39%, grossed up. It was about a bit over 7%. So it's consistently provided reliable income streams, which we know a lot of our shareholders are very much looking for, and a big reason why a lot of you invest in this particular fund. Let's get onto the performance. So let's just firstly deal with the first quarter of this year, so July to date. How are we tracking at the moment? And then let's sort of talk more broadly historically about the journey of CIE, how it's performed in the past, and sort of where you see the performance in the future.
Yeah, sure, Marty. Over the last 3 months, I think we've done to 2.5% up. So I think that I'm reasonably happy with that. When I look around and I see what's happened over, how we've gone over the last couple of years in terms of how the companies reported, how the markets reacted to those reports, etc. I see starting to see some stabilisation or some better results, from how the companies have reported and how the market reacts to that. So I started sort of seeing that probably towards the start of this year, after probably 18 months of some pretty tough times. If we go back to the start when we started this strategy in 2012, the first 5 years of I know this because I've just writing the annual report review for CIE.
And you managed the fund since 2012, the strategy since 2012, haven't you?
That's correct, yeah. So I've seen it all. I mean, the first 4.5 years was basically 15% compound return. So that was pretty spectacular. Looking back in hindsight, it's always easy in hindsight that you can say that some of those stocks delivered earnings growth, but they were probably undervalued at that start of that period, and so they became like increasingly more fully valued. And that probably by 2017, that the job of trying to pick good risk return in this universe became much more difficult than what it was a few years beforehand. And trying to still keep yield up while keeping risk under control, because we don't want to sort of slip down to buying companies which one-trick ponies, or they're going to give a good yield and then disappear the next. We try and avoid that area, and I think that. But so the universe became quite constrained, and probably the other thing that I underestimated, and obviously I'm a reasonable shareholder in CIE, so so I'm pretty focused on what actually happens in this portfolio. But the thing I underestimated was the impact of the Royal Commission on a lot of our companies. I've got to admit, I wasn't paying a lot of attention to it at the start. I ended up paying a lot of attention to it, but it's I think what happened there, because a lot of our companies, we like companies that are stable. They're not likely to double in share price, but they're likely to deliver good, consistent dividends, good balance sheets. And when the Royal Commission came out, and there's all series of government commissions in the utilities, gas, RAB, regulated utilities, etc., electricity, across the whole, and they actually, a large proportion of our portfolio was actually impacted by these, by this uncertainty. And it wasn't only uncertainty, we could probably deal with, it's uncertain and you can see, a good ending to it, you persevere, but some of those business models came under pressure through regulatory changes, and we lost some value during that period. Now, so that certainly impacted performance over the last couple of years. Now, that sort of finished. As I said, I can sort of start to see, a better rate of return coming, and also just, as I said, when our companies do positive things, the market usually now is responding in a more positive way.
Shawn, can you give us some examples of some of the holdings that have provided reliable income streams, and hence why they're in the portfolio, but are well-known brands? They're obviously big companies. They're in the sort of 30 to 200 universe. But can you give us some examples of companies you mentioned before that sort of underperformed, albeit continued to pay the yield that you were looking for?
Yeah, I think that there was. Well, we have. When you look at our portfolio, we've got a reasonable position in things like Tabcorp. That's been, it pays a strong dividend. The balance sheet has a bit. They took over tax through this period as well. The lottery company, which I think was a good move, will end up making the company stronger in case. But that's continued to pay its dividends, though, and ekes out returns, though. The share price has not done much over the last couple of years. And the leasing companies as well, so Macmillan Shakespeare and Smart Group, if you look at type things like that over a couple of years, they probably haven't done very much, but they've continued to pump out dividends. GUD, Bapcorp, again, similar story. In fact, you just if you look across, as an average stock that we look at, that's been pretty much the story, that a lot of them, the share prices haven't moved much, but they've managed to give out, pay out a lot of dividends as well. If you look down that list, Medibank Private, Southern Cross Media, etc., are companies there that continue to pay the dividends. but the share prices haven't moved much in terms of in capital growth over the last couple of years.
Okay. I do invite the audience to ask questions, so feel free. Just click on the questions tab, Tom. It's in at the top of your screen, and Tom's our very trusted direct distribution team member. Click on the questions box if you got to have questions, and we'd love to hear from you. So Shawn, in terms of some of the stocks in the portfolio you like at the moment, do you want to maybe give us some examples of that?
Probably a couple. Well, those that have, I think those I mentioned before that have delivered. There seems to be once companies in this environment, companies that deliver good results get treated pretty well until the next result. So they sort of go into the safe space. We have introduced a couple of new companies into the portfolio, and it's probably worth also talking about a couple of the changes we've made to the portfolio manager. But in terms of companies, we've bought a position in the company called Aurora, which is a packaging company. We've been watching this for a while, and we do hold it in our bigger cap, a position in the bigger cap fund as well. And so we've been watching for a while. We've been talking to the company. They actually had, they've had, this is a business that Amcor spun off several years ago. They've had a good track record of improving those assets and doing well in their space of packaging in cardboard, glass, aluminium packaging. They moved to the States and started slowly buying up packaging companies there as well and putting together critical mass. They had actually a poor year this year and the share price has fallen back. And now that we see that as opportunity. They're getting some energy costs, some other one-off costs in Australia, which they have to wear this year. And also they've made some acquisitions there swallowing overseas, and so they've had a flat year. We see them coming out of that, but we've sort of put in a position, our usual modus operandi is to go in slowly and see how things progress and add to it if the story continues to pan out.
Shawn, we've got a question here from one of the attendees, so I will cut you off there, but we'll come back to it. The question is, why is the CIE share price below the IPO price of $1 per share, and what are you doing to uplift it? A good question. That's from Satish. Satish, thank you very much. So look, I think since the company listed in 2015, listed investment companies can trade at what you call discounts or premiums. The company traditionally, compared to a lot of its peers, has traded at a discount of about 5%. About 18 months ago, we were trading at NTA, and over time that discount has widened. I think there are a number of factors as to why that discount has taken place. I think we had a lot of issues, sort of in terms of a potential change in government that I guess put a bit of a negative sort of overlay across the LIC market, and you'll see that a lot of listed investment companies were hit with on the idea that there was going to be a change of government and there was going to be a change to franking credits. We weren't spared on that, and our discount widened. I think also too, our performance, which Shawn talked about, has been challenged based on the sort of companies that we own in that sort of mid-cap income space, so stocks that have been very much focused on providing yield or in that value part of the market. They've been sort of haven't had the growth of, say, some of our peers. What we have done though is we've consistently provided the reliable income streams. As I mentioned before, almost 7% grossed up was declared for last financial year. Best part of the question though is, what are we doing about closing the discount? Look, ultimately it's really about, there's a few things that we need to do. So we've got to continue to provide reliable income streams. That's obviously an important part of it. Performance is another thing that obviously we're working really hard at, and as Shawn mentioned, we believe that there'll be some changes there with regards to I guess a shift in from value to growth stocks. But really the big thing that we're going to do to close the discount, like we've done in the past, all comes down to shareholder engagement. We've just got to increase the number of people that are buying CIE. So about 18 months ago, we invested a lot in marketing. And CIE traditionally is traded at a discount of about 5%, which compared to the peer group is pretty good. About 18 months ago, we embarked on a very big direct marketing campaign through the Switzer organisation. A bit less than 18 months ago, it's probably about 15 months ago, and we had CIE trading at NTA. It was actually trading at a small premium at the time. Look, we went down a path over the last 15 months to really try to get penetration with CIE in the advisor channel. And that sort of came around through a shift in the Contango business model, which was about shifting from I guess, product manufacturer to a marketing distribution platform. And as part of that, we've hired a high quality distribution team. We spent a lot of time trying to position CIE in the advisor market, and we're sort of rated by Lonsec, which is the major sort of ratings house. We've got a good investment grade rating there, but that's taken longer than we would have thought to sort of position the product in the advisor market. So what we're going to be doing is continuing to persist with getting CIE in the hands of new shareholders, financial advisors that want to recommend it to their clients, stockbrokers that want to recommend it to their clients, but we're going to really go back and market this product hard to the direct channel. And basically, if there is more buying than selling, then that's what will get the share price up. So to answer your question, investing in marketing, investing in shareholder engagement, continuing to provide reliable income streams, and working hard to enhance the performance of the fund. The next question we've got is Kurt Tebbit, again, about the discount. Look, I think ultimately it won't take us a great deal to close the discount, Kurt. Look, there's ultimately it really comes down to getting more shareholders to buy it, but it's just as much as that. We had Jeff Wilson speak recently at the Switzer listed investment conference, and he sort of talked about what needs to be done to close discounts, and he's got a couple of LICs that are trading at discounts at the moment himself, but obviously he's the king of LICs, and it's as much about ensuring that people don't sell, and if you can maintain the shareholder base, because your product's delivering on its promise, and one of our big promises is to deliver that reliable income stream, you can ensure that people continue to stay invested in the fund, and then we can attract some new buying, then that's what we can do to change the discount. And it won't take much to move it. If you look at sort of the screens at the moment, and we've got a very dedicated strategy to take the product out to the direct market and also take it out to that advisor market as well, and we're pretty confident we'll be able to close that soon. Got Luke on the line. Luke, we spoke the other day. So again, sorry, they're all coming through now, which is great. Some directors holding cert, and why are they not showing faith in the fund?
Directors.
So look, I think sort of there's two directors that are currently. What's that?
Read the question out, thanks.
So I would like to see a share buyback commenced and a DRP to cancel the discount while it remains high. So look, Luke, we've announced recently as part of I guess a change in our dividend policy, and also some changes to the investment mandate, where we're actually giving Shawn within the mandate more flexibility to be able to invest in companies that I guess have some more growth prospects. There's sort of two ways in which you can pay income through CIE. One is obviously through the dividend yield, and Shawn, the average market yield at the moment is about sort of 4.35%.
That's correct.
Sort of thereabouts. So the way in which we've traditionally been able to pay that is through what the dividends we get from the companies, but also the capital growth that we get. And traditionally, there hasn't been a lot of capital growth in that sort of 30 to 200 part of the market. So Shawn's got a bit more flexibility now, while still staying core to the portfolio, which is 30 to 200, which is staying in that 30 to 200 universe, to be able to go into the top 30 to look for some growth, or also go outside the 200. So we think that this new investment framework will help generate profits, which will help with the income scenario. In terms of the discount, again, our discount's about 15% at the moment. It's sort of, there's a number of, I guess, our peers that are trading at the same level. We're completely committed and dedicated to closing that through marketing to the direct channel, as I mentioned before, and also to that advisor market. We announced as part of the revised dividend policy, if we have problems meeting the dividend, then we would consider a buyback. But we believe with the marketing strategy that we rolled out, we're going to be able to close that in the short to medium term. But if it does persist, then that's something that the board may consider with regards to a buyback. The next question is from Andrew Bradley. Hi, Andrew, up in Brisbane there. Do you have any views on the current debate triggered by Josh Frydenberg about company payout ratios being too high, paying out too much profit as dividends versus reinvesting back and forth for growth? Is this likely to shift, and is this a real risk for dividends in Australia? Burnsy, I think that's a question for you, mate.
Yeah, that's an interesting one. Thanks, Andrew. I think that when we go back to right at the start when I was talking about and this is a sort of like a worldwide problem, really. It's not only an Australian problem, and I think you'll see politicians start to jump up and down about this more and more as we go, and where that ends up will be interesting. I think we've still got some way to run in that, and the issue all through the Western developed world really is the lack of investment opportunities for companies. We're seeing investment in sort of tech and fintech and things like that, and disruptive technologies. Outside of that, it's very, very sparse, and the reason is that companies aren't seeing the growth opportunities. The growth just isn't there. The capex numbers are falling. And I think that while that continues, they'll pay out dividends, and in the States it manifests itself in share buybacks rather than dividends because of their tax situation over there. But I'd say that is going to continue, and we'll see the politicians get more and more vocal, I suspect, as we go forward, wanting to push the companies to invest, and they're obviously interested in economic activity and employment. That's what the politicians are after, where the companies are after return on investment. And that's, I think it's just not there, and so the companies are paying it out. I mean, how we can you start to theorise about where that all ends up down the track. And and I'm thinking about that already. But I think at this point in time, I think that the companies will only reinvest if they see a reasonable return on capital, and that needs underlying healthy, growing, strongly growing economy. And we're seeing growth, but nothing that would increase capex. Capex rolls on at a historically low level. So I hope that helps.
Thanks, Burnsy. Another question from Luke. Some directors have nil holdings in CIA at 30th of June. Why are they not showing faith in the fund? Well, the two independent directors that have been there for a number of years both have material holdings. Two directors who recently resigned. The chairman, he didn't have a holding, so he is no longer a holder. The other director who's just come on board is actually myself, yours truly, and I'm going down the path of looking to buy some shares, and that's a very fair question. I do have obviously a material amount of shares in Contango Asset Management, which is the manager. So my fortunes are very much leveraged to the success of CIE, but I will be buying some shares in the fund very soon, Luke. And good question. The next question is from Nava. Hi, Nava. Good to have you here on the webinar. How is the management fee paid by CIE to its managers? Can the fee be paid in CIE shares until the discount to NTA is closed? Your thoughts on this, Marty? Well, look, it's an interesting question, Nava. It's the first time that's been posed. The fees are paid to Contango Asset Management, which is an ASX-listed funds management business. Contango Asset Management charges the fund for its fees that are paid for the management of that fund to pay Shawn and his team. In terms of can they be paid in shares, look, it's not really probably a typical approach, and probably pretty hard for a listed company to be able to forego a revenue stream and take stock. Potentially that might be something that a private company may be able to consider, but for a listed company that would be rather difficult. I think that, look, whilst the discount is there, the discount hasn't always been there, and LICs are cyclical and they go through periods of trading at discounts, NTA, or trading at premiums for the better LICs. I think that what we have continually been able to do as a listed investment company is provide a consistent income stream. To pay grossed up 7%, in a market that, or in an environment that's, very much low rate, low earnings growth, we've delivered on a major part of that product. And so the next piece now is to sort out the discount. We've sorted it out in the past, and I genuinely believe with the marketing strategy that we've got and the fact that we've delivered on the promise of being able to continually provide income, there's going to be a lot of support for new investors to start buying CIA. And if we continue to get the faith that we're getting from our existing shareholders here on the line now, then that gap can close pretty quickly. So long way of saying, interesting concept. I don't think that will fly, or I can say that it won't fly, and but it's a very interesting concept, Nava. Shawn, anything to add on this?
On issuing shares, I don't want to issue too many shares as a shareholder in CIE. I don't want to issue too many shares at this type of share price. I think that I think that's too cheap. You've got a portfolio worth 95 cents trading at 80 cents. I'm not a seller at that level, that's for sure. Is it worth talking through the changes to the portfolio?
Absolutely. Yeah. So we touched on the changes to the dividend policy, but we've also talked about changing the investment framework, not the mandate, to give Shawn more flexibility to look for companies that have growth prospects in order to contribute to the income objectives. So Shawn, maybe you want to take it from there.
Yeah, I'm pretty excited about this. It's not a huge move, but from my point of view, it's reasonably significant. And where does this stem from? I think that as I was explaining before, in terms of like the performance up to 17 was pretty, it was very good, and there's no real reason to sort of think about changes at that stage. The last 2 years we've seen performance soften, still positive but soften, and I think that we've held that universe, so X30 high yield, very firm. We've been very rigid on that. Now one of the things you can say, the conclusion of that is at certain points in the cycle that universe becomes very constrained, and I can see it. I say CIE at times is hard to manage in terms of trying to find opportunities to buy companies at good risk return trade-offs if you stick to those constraints that are put onto you all the time. Now, we also run as a lot of you would be aware, and a lot of you are shareholders, as I am, in the Switzer Dividend Growth Fund, which is a larger cap, doing much the same thing as CIE, but in the larger cap space. And what we had done there, and I think it's been quite successful, is sort of blended having a high yield, but also having a portion of the portfolio reserved for actually adding value into share price appreciation. So looking for companies that share prices we believe are going up. Now, outside of the yield, they may have a high yield, they may have a low yield, but we're seeing we're effectively substituting capital growth for dividend for a proportion of the portfolio, which in Switzer's cases is somewhere around 20 or 30%. So we're keeping a high yield, that's the 60 or 70% of the portfolio. The other 30 is opportunistic, looking to add value. And I think that we've come to the conclusion that we probably need to do that, or we are doing that and have implemented that in CIE. And I think that's a very positive thing, because as a portfolio manager, what that means is that I have the flexibility now. If I see a stock that I think is actually, we're going to make money out of, I can actually buy that regardless of its yield. And that's a significant change in managing the portfolio, because it means that I don't have to buy stocks which may be second, third or fourth choice just because they have a yield. I can go out and buy things, and we've seen that. We're seeing the early stages of that already, and it looks promising. And from a management of the portfolio point of view, it does improve it, and I think that will lead to better performance and better returns going forward. It sort of relieves as a pressure valve in the portfolio, and so I'm sort of excited about that. So as a portfolio manager, so I hope that.
We look at the we just talk about the and that's a great summary, mate. But we just also look at sort of companies that we've been investing in, and you've always talked about it's really hard to find a benchmark, the CIE. But if we look at sort of how it would compare against, I guess, an X30 benchmark, or sort of stocks within the 30 to 200, you just want to sort of just run off that point a bit?
Yeah, as a lot of you would be aware, X30 is not really, there's actually no benchmark for X30. And this is going back, well, as I said, we have sort of adjusted a bit going forward. So we customise our own benchmark, which is basically all the stocks market weighted outside of the top 30. So it goes from 30 down to 500. And we have a look at that. Now that benchmark includes a lot of stocks with no yield. So a lot of startups, a lot of small mining companies, etc., biotech companies, etc., a lot of stocks I've never heard of as well, and probably will never hear of. And so it's a bit of a mishmash, but it does include all of our core holding, which are usually the largest stocks in the portfolio, in the index and the portfolio. Now over the last year, that index has done just over 5, and we've done just below 5. So and that gives you a context of when we say soft performance, it's not too bad. It's close to benchmark, and that difference is sort of in the strong market. A lot of the smaller type stocks, like you see, a lot of the tech stocks, etc., have rallied really strongly over the last year or so. Now the top 20, for instance, over the last year to June, did I think 14.2%. Now that's really unusual for that differential in performance between the where we're looking in the top 20. What drove that top 20? Just so you know, I mean, it's like stock, unbelievably, as I sort of had to look twice, something like Telstra up 50%, that's off its lows. CSL still chugging along, doing, that's a good company that continues to do well. The miners had good years with iron ore price doing what it is. So Rio Hills, strong years. So that sort of pushed the top 20 index. That is actually quite unusual, but it is what it is. So that's led to a significant differential performance over the last year. Usually that sort of evens itself out over a number of years.
A couple more questions. So, Sarah, I'm holding CIE through CHESS. Could I buy more at 80 cents? You're holding it through CHESS? Absolutely. And look, I think, as you're going to contribute to your existing holding, or you're looking to add this to your portfolio, you've got an opportunity at the moment to buy the stocks within this portfolio at a 15% discount to what you could buy them on market. So you can absolutely buy them through CHESS, Sarah. Another question from Andrew. Shawn, I'll give this one to you. With interest rates low and they're probably going lower, where do you continue to look for attractive yield outside your more concentrated holdings in A-REITs and financials, or do you possibly consider growth as an alternative source of return? You sort of touched on that, Shawn, but maybe just respond.
I mean, good question, Andrew. I think the way I'm sort of looking at the market at the moment, I see sort of 4 buckets of stocks. So just trying to simplify, make a complex thing sort of simple as I can without completely messing it up. So the first bucket of stocks I look at is your yield, like your REITs and your infrastructure utilities, etc., which are very stable and probably yielding around 4% now, unfranked. As a group, that with interest rates low and going lower, that has, from my point of view, that has to be part of your portfolio. And it's a significant part of CIE. The second bucket is your more cyclical and financial stocks that usually throw off a good franked dividend. We have been, that's a fair bit of our holding. That now, in truth, the last 2 years have been pretty difficult for that bucket of stocks. they've really suffered, struggled in the slowing, with housing coming off the Royal Commission, etc., etc. But that, so we try and pick the eyes out of that, but it will to try and obviously hold shares where the yields are sustainable and the underlying operations of businesses are not going backwards and not under a lot of structural pressure or debt pressure, etc. So that's actually a lot of our time and effort gets focused in that bucket, because that throws off the high frank yield which we're looking for with CIE. The other two buckets are like growth and resources, and I'd say that we, with the change in strategy now, we are being opportunistic in those two buckets where we see opportunities to buy shares in either that resource shares or growth companies that we think we have ability, or we can see opportunity to make money out of. So they may not have a yield, but they, for the large cap, example of that is like CSL in our large cap fund, Switzer, that we had CSL around $120. Its yield's only 1%, but now it's 240. So it hasn't had much of a yield, but we get that capital gain, which we will realise, and that helps. It helps supplement the underlying yield of the portfolio. So that's the aim, to do that with CIE with a proportion of the portfolio as well. Hope that helps, Andrew.
Yeah, a couple more questions, but we are running out of time. We'll take one more, and then Nava, you've got a couple more questions. I'll give you a call after the webinar, mate, and we'll run through that. But we've just got one more question which just came in before. Burns, any plans? This is from Satish. Any plans to make the dividends 100% franked?
Yeah, I think franking is pretty important. I think, but it has been a double-edged sword for the way I've looked at it. I mean, accessing that franking has been a bit problematic. I mean, a lot of the companies that have franking have been quite risky and variable over the last couple of years, so we've sort of approached that a bit with caution. The REITs, utes, infrastructure, obviously not much franking there. I think that when we look at I can work out the running yield of the portfolio franking. I think that it can probably runs, and depends where the overall what dividend we pay out, but the franking will not change no matter what we pay out in dividend. To go to 100% is probably a bit of an ask. I think probably and it really depends what sort of dividend we pay out there. But the one thing about reducing the dividend from 6.5, the franking, that franking does not change. So we were paying like 50% on 6.5, so 3.25. That 3.25 stays no matter what the actual level of dividends we pay out. So say it's 4%, then that'll be 3.25 on 4. If it's 5 cents, 3.25 on 5. So you can work out the proportion of that. I think that over time, that franking will increase, but it will probably increase slowly.
Okay, well, look, that's all we've got time for, ladies and gentlemen. Shawn, great to chat. We'll be doing these webinars on a regular basis, no less than quarterly. We really appreciate everyone's time. We really appreciate everyone's support and the trust that you place in us to look after your money. And thank you very much. And Nava, I will be giving you a call straight after this webinar. Thank you very much, and reach out to us at any time. You've got my details, should be accessible. You got Shawn's, you got Tom Hickey's here as well. Thank you very much, and we look forward to talking with you soon.
Thank you.
Have a great day.